Hey, good morning, everyone. This is Eric Walters, Managing Partner at Summit Hill Wealth Management. I appreciate you joining us for a fourth quarter 2002 market update. I know that as we get the webinar started, people will start kind of filtering in. So for those of you that are just filtering in, thank you for joining us. Today, I wanted to, answer probably, the most common question that I get from clients, which is, are we in a recession and what's the outlook for the stock market? So those are kind of the two things that I'll address initially, and then I will talk about my theory about why investors should approach investing like scientists and not cavemen. So again, for those of you that are kind of rolling in here, this is Eric Walters, Managing Partner at Summit Hill Wealth Management. So I'll get started. I'm going to share my screen and expect people to be joining us, kind of in the next few minutes. While we get started, I just want to encourage people that there is a Q&A button on the bottom here. So go ahead and use that, and love questions. We've already gotten a few ahead of time, and we'll make sure to address those questions that people shared ahead of time. And then also, as I'm going, please don't hesitate to share. So again, as people roll in, I want to thank you for joining us. This is Eric Walters, Summit Hill Wealth Management, and we'll be talking about stock market, the economy, and how investors can respond. So here's our agenda for today. I'd like to talk about whether we are in a late cycle of an expansion or a recession for the economy. Is inflation peaking? What's the outlook for interest rates? I'll give an update on the market, and I think most importantly, how investors can respond. Be a scientist, not a caveman. If you aren't familiar with Summit Hill Wealth Management, we're a boutique wealth management firm, and we help clients protect and grow their assets so that they can focus on what's most important to them. We do that through financial planning and portfolio management. So if any of these topics kind of resonate with you, or if you would like a second opinion about your finances, we'll have our contact information at the end. I would love to talk to you about how we can help. So the first thing I'd like to talk about is just where we are in the economic cycle. I love this chart because it just shows the normal progression of economies from kind of an early expansion into kind of a mid-peak to late growth into a recession. And, early expansion is what we experienced in late 2020, early 2021. There's usually a huge amount of pent-up demand. Inventories are low. Companies are scrambling to meet demand. In the middle of the cycle, growth is peaking. Credit, in terms of loans, is good. Profits are growing, and then they start to kind of stall. And policy is usually neutral, low interest rates. So this is, most commonly recently in 2021, because the Federal Reserve kept interest rates low. Companies were experiencing excellent demand. Consumers were spending like there was no tomorrow. And you could look in the background and just see that real estate prices, consumer spending, cryptocurrency, and other assets were, exploding in demand. And then late cycle is what, the data seems to indicate where we are. You can see where the US and other developed economies are right now. And you could see the characteristics here. Growth is certainly moderating. This is GDP growth. We technically have had 2 quarters of negative GDP growth, very mild. The numbers for GDP growth in the third quarter came back as actually positive, 2.6%. So we've had, kind of slightly negative GDP growth, and then, positive here. Credit is certainly tightening. That just means that banks are more careful to lend. Earnings are certainly under pressure. Through the summer, we've gotten that report from a number of companies. And lately, the corporate quarterly earning calls have shown a mixed bag. Some companies are struggling. Some companies are actually doing okay. So mixed bag with earnings, but certainly more difficult than a year ago at this time. And the policy is certainly contractionary. The Federal Reserve, after saying a year ago inflation was transitory and they would not be raising interest rates, they have gone a full 180 degrees the other way, saying inflation, may become entrenched, and they're going to raise interest rates as much as possible, and they have done exactly that. And inventories are growing and sales are kind of stalling. So I'm going to make the argument that we are still in this late phase. We are not yet in recession. Now, could I be wrong? Yes. And I was talking to a client last week, and he said he was sharing some projections from, such and such economists and such market strategists. And I said that he and we should trust economists and market prognosticators to the extent that they've been correct in the past. And he and I both had a laugh, because if you look back at the track record of economists, market prognosticators, and you see they don't have such a great track record. They come out with very scary headlines, very, very scary analyses, but in general, they're not always very accurate. So, I prefer to focus on the data about where we are. We can make some inferences about the future, but I think we have to be careful about that. You can see the description of what a recession looks like. I don't think we're there yet. We may, reach a shallow recession, but I don't think we're there yet. So this is where I think we are as, an economy. You can see some economies are ahead of us if the data, is correct. They are kind of already in recession. Now, one question you could say is, well, what's the difference between late cycle and recession? I think a lot of people would say, yeah, same thing. 6 of one, half a dozen of the other. We're going into recession. Actually, there's some pretty important differences, and this chart I think does a good job highlighting the differences. So, for example, in late cycle, the GDP growth is moderating. Maybe kind of going down, but it's not actively falling. And as I mentioned, we have had 2 quarters of negative growth this year, but they were very, very slightly negative. So we don't have growth falling off a cliff or even going strongly negative. In fact, Q3 was positive, and the labor market is tight and peaking. I think that's exactly where we're at right now. The labor market is still incredibly tight, and the unemployment rate is still about 3.6%. So we have not seen job losses accelerate yet. Credit is tight. The yield curve flattens and then inverts, and that's what's happened this year. The yield curve inverts, meaning short-term rates are higher than long-term rates, and that traditionally has signaled a recession will happen in about 6 to 18 months historically. But, we haven't seen access to credit completely drying up. And then the Fed policy becomes contractionary. As I mentioned, that's happened this year. The Fed has been really clear that they will do that again. And in a recession, the Fed usually is easing. So we don't have that. And then, as I mentioned, corporate profits growth has been under pressure. Corporate earnings have been a mixed bag, the last 2 or 3 weeks. Some companies like Delta Airlines, for example, and most banks saying we're actually doing pretty well. Profit margins are certainly under decline. So you have some companies saying we may start layoffs, we may start cost cutting. And then, of course, corporate profits are usually in decline in recession, which is kind of one of the main features of a recession. But we haven't seen that. Now, there's been a lot of prognostications that it's around the corner, it's about to happen, but it hasn't happened. And then, this is kind of a technical indicator if you look at financial statements, but inventories rise relative to sales. That is happening right now. And then recession inventories actually fall when companies are just working down their inventories and they're not building them back up. And that sets them up for low inventories when the turnaround happens. And so actually, if you look at the inventory to sales ratio, again, this is super geeky, but if we want to try to figure out where we are, the inventory to sales ratio actually is elevated just as it did in 2020 and as it did in 2008. So that's why I think we're actually in this late cycle, and I don't think we're in a recession yet. And what's the difference? Well, the difference is actually that the market behaves differently in a late cycle than it does in a recession. And that's part of the point I want to make is that things are actually better than I think a lot of people look at. When we look at the labor market, we look at positive GDP, we look at corporate profits. It's actually, better. And because I think, most financial news focuses on the negative, we just hear about all the bad stuff, but actually, it's a little more balanced, I think, than that. So how do we determine if there is a recession? These are the 6 inputs that the NBER, the National Bureau of Economic Research, looks at to determine if there was a recession. So this is something that happens in the rear view mirror. And so, we can look forward, but eventually the NBER actually says, yes, there was a recession back then. So if you look at their inputs, you can see it's income, employment, consumer spending, sales, industrial production. And you can see this kind of heat map of what it's looked like. And of course, in 2020, it was completely negative, and then it was incredibly positive after that. And then it's been kind of checkered, back and forth. But right now, if you look at this data right now, and you can see this in the bar on the bottom, actually these 6 components are actually doing okay. So this just kind of lends another data source, looking at this idea of, are we in recession? The data, would just kind of say, well, we might be headed towards one, but it doesn't seem as if we're in one right now. Now, a big part of why I don't think we will, be in a recession, this moment. And even if we do, my argument is that it will be a shallow recession, is that employment is so strong. And these 2 charts show, one, just how high or just how good employment is, and that wages are growing up by quite a lot. So you can see this chart on the left just shows, kind of the US unemployment data. It's all these data points, and that basically as unemployment, goes up, job openings go down. So that's what this is here. Job openings here, and this is unemployment. So as unemployment goes up, job openings go down. That's kind of, duh. So where were we in August? Well, we had very low unemployment and very high amount of job openings. And that just means that if you're breathing and you can show up to work on time, you probably can find a job right now. And I talked to a number of business owners. They're primarily the clients that we work with, and they just say, man, what I wouldn't give for people that show up to a job interview and accept the job and just keep showing up. So that's really positive. And so if we look at this the other way, right now, the employment rate is about 96%. And if we have a recession, the employment rate might go down from 96% to 92% or 91%. But that still means 9/10 of everyone in the United States that's working age and wants to work is working. And generally when people are working, they want to spend money. They buy shoes and they go out to eat, and they kind of go to vacation. Now they might not go to Fiji, they might go to Florida, but in general, when people are employed, they spend money. So this is part of the challenge the Federal Reserve has right now, is actually they wouldn't mind if the unemployment rate went up and a lot more people curtailed their spending. So it's not that they want a lot of people out of work, but they wouldn't mind if a lot of people pull back. But this is one of the reasons why I think, when and if we do go into a recession, I think it'll be mild. And the other chart here just talks about wage growth. You could just see just how high and how quickly wages are growing. This is putting pressure on private and public companies, but it's good, again, for consumers, and consumers drive about 70% of the US GDP. So if we look backwards to this data, and if we look forwards to kind of unemployment and job openings and wages, it's hard for me to come up with a really nightmare scenario about a recession, that it'll be so deep, it'll be so terrible, it'll be so horrible. That's what I think we kind of read on the news and maybe we project in our minds, but it's hard for me to imagine that when I look at the data. Of course, that could happen. Something could change, but it's hard for me to take a look at that and say, oh yeah, we have something horrible coming down the line. I will point out that a shallow recession does not necessarily mean that the US stock market or the bond market will also have easy goings. The two are not always aligned, and I think that's where sometimes people make a mistake. They assume if the recession is shallow, the market will be just nice and easy, and that's not always the case. So we'll talk about that. So I think the key thing to focus on is inflation. That's been the story of this year for sure. This chart from JP Morgan just highlights energy prices and how they have been coming down. If you've been paying attention to oil and gasoline prices, down quite a lot. That's really positive. That shows less demand, and it shows likely that inflation, I think, will continue to head down. New and used vehicles getting a lot less expensive. Food still somewhat expensive. This is kind of a catch-all other category. Hotels and restaurants are still trying to charge what they did in 2021. I think those prices will come down. Shelter is coming up for an unusual reason. The input here in CPI is when the Federal Reserve, and I don't know who thought this up, they send a survey to homeowners and they ask homeowners, what do you think it would take to rent your house? It's called owner's equivalent rent. And now if you're a homeowner, you've never rented your house. You pick a number out. I don't know, is it 2,500? I don't know, is it 3,500? Is it 4,000? I don't know. So they made this change a number of years ago. It's kind of odd. But by that measure, homeowners think it would take a lot more and more and more to rent their house. And I'm skipping over some key details here, but it's not the most scientific part of the CPI calculation. And so, it's going up and up and up. And, some homeowners may be educated about this. I think 99% of them are not. But nonetheless, my belief is that inflation has peaked and will continue to trend down, but I think it will trend down to the 4 to 6% level, and it could be a while, but nonetheless, I think it's happening. One reason I believe that is consumer expectations for inflation is incredibly low. The data here, this kind of lighter blue line, shows consumer expectations for inflation is still back in the 2s and 3s. There's two ways to look at this. One is that consumers are completely crazy. They have no idea, and they're just going to get hit upside the head with a 4x4 of inflation, and they're in for a world of pain. That's, you could kind of read that article on whatever, amateur investing blog. But, people are not really dumb. And I think they are basically looking at things and saying, nah, it seems like things could get back to normal. They could be wrong. But professional forecasters also think it's wrong. And professional investors also think it's wrong. And this is the professional forecasters and the 5-year break-evens, think that inflation will moderate. Now, I think it'll be higher than people are expecting. I think part of this is people saying, oh, maybe it'll go back to the way it was. I don't think that's necessarily going to happen when you think about things like food, when you think about things like restaurant prices, probably go down, but I doubt it'll go down to what it was before. But nonetheless, people who are investing for a living and their lifestyle, their job depends on getting this right, believe, that inflation will moderate. And so there's a debate within economics about whether consumer expectations drive inflation or if inflation drives expectations. It's a weird chicken and the egg, and the field of economics hasn't figured it out. But nonetheless, consumer expectations are important because it drives their spending. If consumers believe inflation is going to skyrocket over the next year or two, they will stop spending, right? They will spend now, right, in order to avoid paying more down the line. So it means they will buy a car now to try to avoid spending more for a car in a year. And we're just not seeing that kind of inflation hoarding, kind of attitude in consumer surveys. So we're not seeing that. People are not suddenly stocking up on canned goods or trying to bunch a bunch of clothes or, kind of panicking. People are kind of just going about their life. So again, could the people be wrong here? They absolutely could be. But the fact that consumer expectations are so low is a really interesting data point. Now, the only thing more difficult to forecast than inflation is interest rates. And just like I was talking to a client yesterday about economic forecast, the Federal Reserve has an amazing track record of being totally wrong. And so whatever the Federal Reserve is kind of putting out there, here's our forecast and we think this, and it's very, very serious, or don't worry, you can almost kind of look at it and say, well, they're human just like all of us, and they're flaky and they're doing their best and God bless them. But they've been totally wrong so many times because turns out it's impossible to predict the future. Who would have guessed? But nonetheless, the Federal Reserve and market participants do see interest rates kind of peaking and then rolling over kind of in the near term. And that's because they're looking at the same data around inflation. Again, could it be wrong? Absolutely. But the Federal Reserve is kind of one of the main players in this drama. And if they think interest rates will start to moderate, as they've said, in kind of news quotes recently, then that's an important input. So it's very likely that if inflation continues to kind of trend down, and if interest rates do stop their rise, kind of flatten out and head down, then we would be in that recession, mode. And paradoxically, the markets would be up. I'll talk about that in a minute. So, here's the data on what's been happening in the stock market, both in the third quarter and year to date. I'll let you just take a look at this. And this is one of those times in your life where you will look at your 401k statement or your investment statement, and you just kind of close your eyes, put it to the side, put it in the shredder, and, grab your drink of choice type thing. It's just a really difficult quarter and a difficult year. And if you're an investor, you've been through this in the past. And I like to say that the stock market is a lot like weather in Colorado, and that these type of markets are like a really bad hailstorm. If you live in Colorado, these hailstorms come through, probably 2 or 3 times a decade, and they wreak havoc, right? There are trees down, they destroy roofs, they'll destroy cars, they'll, do some really big damage. You get golf ball size hail and it could really, really do some damage. But you kind of come out afterwards, and you'd be like, well, we need a new roof, we need new gutters, the car needs to be fixed, but it's okay. And that's kind of what happens here. We're in this kind of storm of returns, but this is not the final story. Markets have always recovered, and I'll talk about that later. So here's what I mean about why the stock market actually could rally if it looks like we're in a recession and the Federal Reserve is pausing interest rates or even increasing them. This is one thing I think when I talk to clients that is the most different than kind of their normal natural assumption. I think people normally assume that if the economy is going down, the stock market's going down right along with it. And therefore, if the data is getting worse, then of course the stock market's going to get worse and worse and worse. The problem that investors struggle with is that the stock market looks ahead 9 to 12 months. So this means that this year to date, the stock market has been looking forward to the end of this year and has now been looking forward into 2023. And what is the stock market kind of worried about? The stock market's worried about a recession. That's why prices are down. But as I said before, the data on industrial production, consumer spending, and employment actually is pretty good. So that kind of shows that even though the data is actually pretty good, it's deteriorating, but it's still pretty good. The market's looking forward. And now the stock market, as the joke goes on Wall Street, has correctly predicted 10 of the last 5 recessions. That's true. So the stock market is kind of always worried about recession. It's the ultimate boogeyman for the stock market, and you get some market prognosticators, that will say there's a crash coming, there's a crash coming, there's a crash coming, and they're right, once every 10 years. Dr. Nouriel Roubini, otherwise known as Dr. Doom, was famous for predicting the 2008 market crash, and people forget to remember that he predicted another major crash almost every year since then. And then he kind of spoke up and say, I knew 2020 was coming. And now he's like, hey, I knew it. Well, no offense to Dr. Roubini, he's a very smart guy, but his predictions are way off. And he is an example of the stock market at large. The stock market's always kind of worried about a recession. Well, here's some interesting data. If the stock market has worried about a recession, but it didn't appear, stocks were down about 22% and earnings were up 7%. So the stock market was like, whoops, sorry for lowering your values. Go about your normal day. Let's just pretend I didn't totally freak out. And then when the stock market is worried about a recession and it actually happens, on average, the stock market is down 35% and earnings are down 18%. So this is why, the Wall Street Journal is obsessed with Q3 earnings reports more so than normal. It's like our earnings going down. But what's interesting is depending on the day, the stock market year to date is down around, 21 to 24%, depending on the day. And that's not so far off from down 35. So we are closer to a bottom, objectively kind of looking at historical data, then another waterfall of another 40% down or something. So even if we do go into recession, yes, markets could be a little more discouraged here. Could stocks go down? Sure. And clients have asked me, and I've said, I don't really know, but maybe they could go down another 5 or 10%, and then I would expect it to bottom out. And this is the reason why, because historically, as long as you take the idea of like a major depression off the table, and I don't see that with our employment numbers, as long as you take a major depression off the table, in general, in a bad kind of bear market, you're down maybe 30 to 40%. So yes, they could go down more, but because the market's looking ahead, if a few things turn positive, meaning the Federal Reserve stops raising interest rates or slows it down, or the war in Ukraine changes for the better, or inflation continues to moderate. If any of these things move from the negative column to the positive column, I think you'll see stocks, move up. And we saw this in the last 3 weeks. Earnings were coming out mixed, but particularly from banks, we were getting good data. Delta Airlines came out with a particularly good, earnings report. And what happened? Stocks were up on a weekly basis the last 2 or 3 weeks. So I think the stock market has priced in a huge amount of bad news. It's already priced in a recession. And I think if we just get some things from the, super negative column to just move over, like even just one or two, like earnings and the war in Ukraine or something, I think you're going to see the market start to continue to bottom. So from investors, we don't really have to answer this question about whether we're in a recession or not. We have to endure the downturn here. But no, we've already endured the pain. And from here, the market will most likely be anticipating, an early stage recovery. And this is what could happen, my friends. In 2009, the stock market, was heading down. Of course, it crashed in 2008, was moving down even more in the beginning of 2009, if you remember. But the economic data got worse and worse and worse in 2009. But the stock market was going up, and sometimes 4 to 6% per day in 2008. And that doesn't make any sense, except if you realize the stock market was looking ahead to the end of 2009 and 2010. So even while economic data was getting worse and worse and worse, the stock market was doing better and better and better. And I think we could be in a similar situation where we will then confirm a recession with the data. And then the stock market will say, oh, I've already assumed all that. And now I'm looking ahead. So if you are the type of investor that likes to say, I'd like to be careful because the data is negative right now, you are completely missing the boat. Please, accept this in love. You are completely missing the boat, because if you focus on the economic data, such as real estate prices or commercial prices or retail sales, or how it feels when you go to, a cocktail party and your friends are getting laid off, it's actually the best time to buy, because the stock market will say, yeah, I've already priced all that in. So this is kind of the reason why I'm actually thinking next year could actually be an up year for the market. So a lot of clients have said, hey, when do we know if we are kind of at a bottom? And this is a little technical, but sometimes I think I work with a lot of more technical clients, and they kind of like it if you open up the curtain and say, hey, here's what we're looking at. So there are, about 6 indicators that historically have kind of been associated with market bottoms. And these are not rules, these are kind of observations. Unfortunately, investing in economics is not yet a science where we could say we ran an experiment and this happened, therefore, E equals MC squared. It's not like that. It's, more observational, much less precise. But in general, if you get volatility to spike, now it's close. We spiked around 33, you're near a market bottom, so we're close. If the relative strength, which is an indication of kind of up days and down days, if it dips below 30, which did happen in late September, if the amount of put or protection outweighs, calls, goes to 1.5, again, we got really close at 1.4. And then, very low percentage of stocks trading above their 200-day average. Yes, we hit this. It's been as low as 15%, which is really low. If there's a spike in junk bond yields, meaning people think junk bonds are going to default. Yep, we've had that. And then low investor sentiment. This is my favorite one, and I say that kind of tongue in cheek because the American Association of Investors, Institutional Investors, AAII, does a survey for bearish and bullish, and it's completely contrary indicator. Meaning, when this survey is bullish and people are really happy, you should be very careful. And when it's really bearish, it's actually a great time to be buying stocks. So you could tell their current survey data, this is off their website, is bearish at 56%. Now, if you look historically, that's actually usually signs of a market bottom. So they should reformat their survey and just say, oh, you should buy now. But when people are really scared, usually you're near a bottom. And so we get 4 out of 6, and even the 2 that we don't technically hit, we're actually kind of close. So if we put economics aside and say, let's just look at the stock market and the bond market, we're actually getting some data that kind of backs up this idea that we may be near a bottom. Now, again, this is, just speculation. It could be worse, but this is my reading of the data. So speaking of reading the data, I've gone through some technical information about the economy, the NBER, the kind of inputs here, and I tend to do that. I like more technical stuff, but I want to take a step back and just offer my perspective for working with clients for 16, 17 years. In these markets, I think we have a choice between either acting like a scientist or a caveman. And here's what I mean. A caveman will look at their screen or look at their statement and say, market down, bad, and then that's it. They just, maybe they call me up or their advisor up, or they tell their spouse, it's bad, it's the me no likey. But I'd encourage you to take a step back and think about it like a scientist. And a scientist would say, that's an interesting phenomenon. What does the data show? And if it's one thing scientists love, it's data. And thankfully, we have a huge amount of data. And so when markets are like this, I think let's just remind ourselves of the data, and I'll share some of that with us. So if you've been around Summit Hill for a while, you've seen this, you've seen this chart, and that if you look at the stock market, this is a histogram chart of showing each year of returns. And you can see that not only is the stock market positive 75% of the time, and this goes to 2020, but I can assure you the data is the same, but it's heavily skewed towards very, very positive returns, and not like slightly returns, like 0 to 10%, but more than 10% return. So most of the time, the stock market is not only positive, but you're getting returns that are, above 10%. And yes, there are periods where the market is negative, but if you were to just kind of say, hey, I have a chance to grow my money, in general, is it going to go down, or in general, is it going to go up? The data is unequivocal. 75% of the time, it goes up. Now you say, yeah, but that doesn't help me in this particular year, because I think this year is special. And this is what I hear from clients all the time. I'll hear the yeah, buts, and it goes along like this. Yeah, but there's a war in Ukraine. Yeah, but we've had low inflation and inflation has spiked. Yeah, but the federal debt is so high. Yeah, but valuations are high. And you can include in the chart or in the chat whatever I've missed. But the yeah, buts. And the point of the yeah, but comments is this time is different. And usually the underlying thought is, I feel pretty scared, and I'm not comforted by remembering how we've recovered from the tech crash in 2000 and the 2008, and how we've recovered from COVID. It's like, that's in the past, and right now I just feel pretty scared. And I understand that. But here's a chart that shows how the stock market, and this is just global stocks, this isn't even US stocks, has responded to terrible, terrible events, not only in the stock market, but also just in the world, going back to 1970. And this just shows if you invested $1 in the stock market starting in 1970, which was a pretty tough time to start, your $1 would be worth $80. And you can see oil embargoes, huge declines in the stock market here, inflation at 13%, S&L crisis, income tax rates, huge market declines. And then we've got wars, right? We've got major crises, and COVID looks so kind of cute right here, but that's a major decline. So I always tell clients, what I would like is to take your $1 and multiply it by 80. And we can do that if we stay invested, because the stock market is not just some, big amorphous thing that we don't know what it is. It's a collection of companies that are being run for a profit. And if those leaders don't deliver profits for you, you actually don't have to do anything, because the stock market will punish them by lowering their stock price. If that doesn't get the executives' attention, those executives will be fired. New ones will come in and rinse and repeat. And what we get is this amazing money-making machine called the stock market. We just have to trust that it will work. Now, if you're a scientist and you look at this data, you would draw a few conclusions. One is bad things happen on a very regular basis. 2, the stock market responds to bad things by going down. 3, the stock market seems to, after a period of time, not only recover to the prior level, but go up. And so again, if you were a scientist, you'd say, therefore, I should be ready for bad things. I shouldn't be surprised when the stock market goes down. And I can reasonably assume that the stock market will continue to grow over time. There you go. I think that's, I don't want to speak for all scientists, but if I was one, that's, the conclusions I would draw from this data. Now, a lot of people think, boy, I understand what Eric's saying, but on these bad days where it's just so obvious that the stock market's going to go down, why don't we just go to cash and then we'll go in when things look good? I've already talked about that. If you wait until things look good, the stock market was already up usually 9 or 12 months before. So 9 or 12 months before, when things look good, the stock market was always already moving up, and usually in a pretty big way, kind of a plus 20, plus 30% move. So if you wait till things look good, you'll miss it. And then if you miss just a few days over 30 years, you will permanently lower your investment returns. And this is the most shocking chart I think I've seen in my investing period. But if you just miss 5 days, And now usually I should point out the best days follow the worst days. If the market's down 3 or 4% in one day, which is a challenging day, often within a period of time, the market will be up 3 or 4 days, or 3 or 4%. It's just happened recently. Just in the last 2 or 3 weeks, the NASDAQ has been up even 4 or 5%. But if you miss those days and it's just, they're just gone to the river of history, look at how it affects your returns on an annualized basis, 10.2 to 8.6. More importantly, you have, about $7,000 less after 30 years, just missing 5 days in that example. So this is why when clients say, hey, can we just, go to like step over to the side because it's obvious things are bad and it's obvious the market will keep going down. I say it's not obvious that nothing's obvious, right? We don't know how long the market will go down. And more importantly, we don't know when it'll start to recover because it's always looking ahead. And the market is comprised of millions of people looking at data, and they will see things that an individual will miss. So don't miss a couple days, right? It's just the biggest lesson I think you can draw from this, again, if you're a scientist. Here is how a diversified portfolio has responded to major market declines and problems. This is a portfolio of 60% stocks, 40% bonds, and how it performed 1, 3, and 5 years. So a lot of people think, well, if the market's down, then it's going to take 10 years to come back. As my daughter who likes French likes to say, au contraire, mon frère, it is actually not the case. And now, sure, after a year, even 3 years, are you down slightly? Sure. But if you stay the course, a diversified portfolio will get you through. Here's another way to look at it. When we look all the way back to 2007, which was the end of the last kind of big bull market run, a diversified portfolio of 60% stocks and 40% bonds actually navigated pretty well. It was never the best, but it was never the worst. And so you can see this little white, box here. It was never, tippy top, but it was never, in the dumps. And then it also kind of handled this volatile period, which included the crash of 2008, the almost Eurozone collapse of 2012, the China slowdown in 2018, COVID in 2020, and then year to date, it actually handled it pretty well, 6.1%, and it actually had one of the lower volatility readings of all the individual asset classes. So this chart just shows a diversified portfolio does well. It also shows the impossibility of trying to figure out what part of the market is going to be the winner. Because if in 2008, you saw that bonds were going to do well, the lowest performing asset class was emerging market stocks, you'd have to buy that to get the winner for the next year, right? And REITs were down here, and then a few years later, REITs were up. So clients will say, what part of the stock market is going to do well next year? And I'll say, if I knew that, I'd probably own a number of islands in the Caribbean. I don't think anybody really does. So I think it's impossible to say, boy, it's going to be small cap stocks for sure. Now, within our portfolio, we will lean portfolios where we think there's opportunity. And usually it's because things are cheap and out of favor. So I will usually look at things that have been on this bottom quartile here and kind of say, is our investors overreacting? Because what happens is the things on the bottom tend to come to the top. So I will lean portfolios towards things that are out of favor. I'm usually buying, more value-oriented stuff. That's not me saying I know it's going to be, the big performer next year. It's just in general, buying stuff when it's cheap and on sale usually tends to add to performance over time. But I'm not making a call that I think I know where it is in the next quarter or two. But diversification works. So what can you do? Prepare a financial plan. If you are stuck in caveman thinking, meaning the market's down or my 401k is down and that's bad, and I don't know what to do. You need a financial plan that's oriented around your expenses, your income in retirement, your goals like education, and then it needs to look at the risk of the stock market within that. So I've already talked about focus on the long term, avoid selling, particularly right now. And then specifically, you can think about your bond allocation. Bonds are down this year because interest rates and inflation are up. We found that individual bonds have served clients well. So if you're not thinking about individual bond ladders, we think there's a lot of merit. I think if you are, aggressive, or if you have cash, it's a great time to add to stock allocations, either through rebalancing or starting to put cash to work in, kind of small segments. It's called dollar cost averaging. We like diversifiers. So private equity, hedge, managed futures, and even custom structured notes are all things that we do that we think set us apart from other firms. And those have been doing pretty well. A lot of our private equity managers are up over a year. A lot of our hedge managers are doing well. Our managed futures are, in the kind of single digits and doing fine. And we've had some structured notes that have yielded good income and giving up upside or producing upside. So we think those help. So if you're not familiar with those, if your advisor isn't using these, love to talk to you about that. And then I already talked about putting cash to work. And finally, go have fun and go to Europe because the dollar is still really strong, both against the UK pound and the euro. So plan something fun and go use it. When we think about investing, I'll just wrap up with a few key concepts. And I think the key is to think about this, and this has been said in so many areas of life. Think about the things that matter long-term and the things that you can control. And I just brainstormed some. And the things that matter long-term for human wellness and happiness, as it relates to your money, is how you allocate, how much you spend, when you take Social Security, when you retire, income, personal health, and how much energy you put into relationships. Those things matter. Now, what's cool is that you can control all those things, including you can control how often you look at your portfolio. So the things that really, really matter, you can control. And this is the essence of putting a financial plan in place. Now, can we control the economy, stock market, interest? No. And that's part of a plan, is that you have to be able to say, we don't know what's going to happen with these things. And our financial and investing plan has to be able to roll with any punches that might happen. So a good financial plan should not only look at kind of a base case, like, hey, we keep earning money and we're employed and things go well, but it should also look at a negative case. What if some of those things don't happen? Are we going to be okay? And a good, robust financial plan should include resiliency, that there are bad things that happen and we should look at that. So, but the good news is the things you can control determine the majority of your success as an investor and in retirement. So focus on that. In the short term, volatility in investing is very high and the predictability of returns is very, very low. The good news is over time, over a 3-year period, 5-year period, 8-year period, the returns become much more predictable, and then the volatility actually of those returns goes way down. So we're not talking about long-term just because we as advisors like squirm and we don't want to predict the future. Yes, that's impossible, but it's actually because if we focus on the long term from a system standpoint, we can actually do better in terms of predicting returns. Now, we have to prepare for the unexpected in down markets like this, but if we focus on return, we get what we want, which is more predictability of returns and lower volatility. What does the data say? I love data. So if we look at rolling periods of rolling 1-year periods, rolling 2-year periods, and this is of the US stock market, right? When do the rolling periods of returns consistently produce kind of positive returns? And you can see right around the 5-year mark, kind of a rolling 5-year period, returns are positive 90% or more. So my clients will usually hear me say, if we're investing in the stock market, we should plan on time horizons between 7 and 10 years, because in 7 and 10 years, you're in this kind of 95 plus time period. And if you get into kind of 11 and 12, it's kind of in the 100% time period. So if you are new to investing, if you are young, if you recently sold a business and you put cash to work, you're in this kind of turmoil, right? Where on a quarter by quarter basis, it's kind of a toss up what'll happen quarter by quarter. When you get to multiple years, you're more likely to be positive, but still, that's a big spread here. But when you get to kind of these rolling 4 years, rolling 5 years, your predictability and your likelihood of positive returns goes up quite a lot. So again, that's the data speaking. That's not just my opinion. This is the data. So again, invest like a scientist, think long-term, you will get those positive returns. Don't let the market push you off the mark here over a bad third quarter or year to date. This is an example of what our client's financial plan looks like when we, do it. We have assets right here. We want to grow them, and then we're going to start spending them in retirement. We look at what's the probability. And as I mentioned, we look at a median case, and then I focus on the downside. And this is high inflation, high taxes, poor returns, premature death, need for long-term care. All those things should go into that downside stress case, right? And that's how I think you bring your personal finances to connect with the stock market. So if you don't have a financial plan, you're kind of flying blind, right? You're kind of saying, well, here's how I feel. Maybe I feel conservative, maybe I feel aggressive, and the market is kind of moving you all around. If you have a financial plan, you can put numbers to your goals, you can stress test the downside, you can see the probability of success, and you've got a map to kind of go on your journey as you interact with the stock market, as you interact with your loved ones. So that's the plan. One example I'll give you here, I'll just wrap up with, one benefit of higher interest is you can do a lot better in terms of income right now. And so what we've been seeing is if we create a laddered bond portfolio, this is just one example from earlier this year, the numbers are very similar now, is that with $1 million portfolio, you can generate about $54,000 of income or 4.99% per year. That's taxable with only a 4-year average maturity. So this is an example of, how I think people that are near retirement or in retirement can deal with volatile markets. And so I'm just going to use this to kind of transition into questions. So, while I'm talking, if you want to type in a question in the Q&A, please do. But we did get a question that said, if there is the chance of a really serious recession on the horizon, should you delay retirement? And that's a really good and a really important question. So thank you, Laura, for that question. So I think if you've been preparing a financial plan, and if your financial plan has this downside, part of your analysis, and if your financial plan shows that you can survive the downside, then I don't think you have to delay your retirement, because a good financial plan should already have anticipated this. And one of the ways I think a good financial plan does that is that you should have some cash available for the next 12 to 24 months. You can imagine a bucket with cash. And then you should have another bucket that has bonds in it that are going to come due and then fund that year's spending. And that can be anywhere between kind of 4 and 8 years of spending could be in this middle bucket. And then you have stocks that should grow over time. And as we rebalance, we'll take some of that stock market profits, build up this middle section of bonds, and then it'll fund cash. And I'm just going to pause my sharing here to show you another example of what that looks like. So if you'll just pause with me. This is a graphic that I share with clients, and it just kind of shows this graphically. And I think if you are planning for retirement, or if you are in retirement and you are thinking, oh my gosh, there's no way I can retire because market's down. Actually, you can. And here's why. Because here's a bucket that will be your spending bucket over the next probably 1 to 2 years, right? So I recommend clients basically have this money either in cash with us or cash with themselves that they will spend. Then you've got this bucket that usually has mostly bonds, probably with some stocks that are generating income. And it's just like that bond portfolio. And so this is the safe money. And then, if we ever, basically as these bonds mature, we create a paycheck for the next year. And then this is the growth-oriented portfolio. And this money over time, as we've seen, will grow. And as we rebalance, we'll take money from this bucket, buy some more bonds. Those bonds will mature. We will fund this bucket for spending, and we will naturally spend down your assets, but in a way that is sustainable. Now, the beautiful thing about this is when you have, a year or so of cash, when you have maybe 5 to 8 years of spending in income, you don't need growth from the stock market for 7 to 8 years. So what happens year to date in the stock market, it doesn't matter if you follow this strategy. So that's a beautiful thing I like to tell clients is, yes, the number on your statement is down, like caveman thinking, number down bad, but we still have cash and we still have bonds, even if those bonds are down, and there's no need to change your personal spending. Now, some clients may struggle with spending too much, or they may want to cut back on a certain type of trip, think Florida rather than Fiji, but that is, I think, the time-tested way. This has worked for people for decades on how in retirement you navigate a difficult market. So I will kind of pause there. Again, love questions. So please go ahead and share any questions. Another question that we got is, how can we prepare for uncertain times? Now, that's a broad question, but as a financial planner, I'll offer a few kind of broad observations, and hopefully they help with whoever asked that question. I think the first thing I always do is make sure you have a cash reserve. I think a cash reserve is one of the best ways to prepare for uncertain times. And in general, if you have both spouses working in very steady jobs that are unlikely to be laid off, you could get away with maybe 3 to 4 months of emergency spending. If you have one spouse working, I'd move that up to 6. If that spouse's job is in a volatile industry or can be, laid off more easily, like if you're in sales or if you're in oil and gas, or I would move that up to like 9 months. And then if you are a business owner, I feel you, I run our own business here. You're on the tip of the spear of volatility. Then I would have more like a year of personal expenses, and I would have some retained earnings in the business. So the first thing is cash reserves. Second is prepare a financial plan. Know what your spending is, track your spending, and project it forward, and figure out what you're aiming for. What is your great retirement? What are the goals that for you would really make you feel like, wow, I feel great about that? Might be paying off your mortgage, might be getting rid of student loan debt, might be selling your business, might be preparing for retirement. Put it down on paper, and just see, are we going to get there? What will it take to get there? So that's the next thing. And then I would look at your investments and just kind of have some observations. Maybe you were kind of doing this alone, and maybe you were too aggressive. I don't think I would sell now, but at some point, I would recommend working with a professional to say, I think I was too aggressive, or I probably shouldn't have gone into crypto, or maybe owning 4 condos was a little much for me, and make some adjustments so that the next time the market's down, you can handle it. And then if you are an employee, this is the time to dig in, improve your skills, find out what your boss's priorities are, and help your boss deliver on their priorities to avoid, getting laid off. I mean, I think any manager, any leader would say, look, if I have an employee that understands my goals and my challenges and my stressors, and they are upping their skills, they're kind of showing up a little bit early, they're kind of helping me knock off my list, they're a keeper. If you get someone else that's like, I've got to work from home, and I got to take off every Friday, and this doesn't work for my work-life balance. I think work-life balance is incredibly important, but in times like this, companies, I think, are more selective on who they keep and who is out. So I would, if you are a W-2 employee, I would focus on priorities. I would focus on upskilling. I would focus on showing up, and I think, in my experience, that helps you, avoid some negative situations with your job. As I said, the job market is still really strong. So if you are in a negative situation, that's not a bad time to network and look for other opportunities. I just want to check in and see if there's any other questions out there. I'm not seeing any yet. So I will say thank you to everyone for joining us. I love doing these webinars. I love especially getting the questions ahead of time. If you are a client of Summit Hill Wealth Management, thank you for your business. You are the most important thing in the world to us. And if you have any questions, if this has raised anything you want to talk about, please reach out to me. If you are not a client and you would love a second opinion, my email is info@summithillwealth.com. You can just send us an email. We would love to go through our process with you. It is a no pressure situation. We give you a second opinion. So again, Eric Walters, Summit Hill Wealth Management. Thank you. You can reach me at info@summithillwealth.com. Thank you.